going to a different economy, and we're going to be learning more about that as we go. But clearly, we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So what happened to the manufacturing workers is a very clear sign.
This effort. And China has big plans for this. They intend to seed their digital yuan into the global environment by giving it away to visitors at next winter's Olympics. When they arrive at the airport, they're going to get yuan digital wallets. They're going to receive digital yuan. They're going to use it throughout their visits to Beijing, and then they're going to take it back to their home countries. They see this as a huge advantage. Why? Because who controls the underlying protocols, who controls the underlying standards of the future of money will control the future of money.
Welcome to the Crypto Teacher. And guys, I come back with that video just to make you think. And that's right, guys, we had Jerome in the house. And this is probably one of his worst meetings I've ever seen, because he did not answer not one question directly. So that let us know this is the calm before the storm. He was asked about tapering the balance sheet. Treasuries never gave a direct answer. Also with digital currencies, said the same exact thing. We're just going to wait. The digital yuan is just for China. That's not correct. It's going to be a global currency. We had Giancarlo say the same thing. We know that Alipay and WeChat will allow the digital yuan to go global. And we heard that from PayPal CEO and Ripple's Brad Garlinghouse. Now, when it comes to the housing market, a great question at the end. If the housing market is so great, why are we buying mortgage-backed securities at this rate? We know why, because the Fed wants to be the last resort. Remember, you will own nothing, but you will be happy. And if you guys notice, Jerome always says this statement, we're moving to a new economy. He's speaking to corporations, and they're working on technology so they can use fewer people. If you've noticed that, he said that in every single meeting. He's letting us know when it comes to the New World Order, it's all planned out. Have a wonderful day.
It seems unlikely, frankly, that we would see inflation moving up in a persistent way that would actually move inflation expectations up while there was still significant slack in the labor market. I won't say that it's impossible, but it seems unlikely. It's much more likely that we would, having achieved maximum employment conditions, we'd also be seeing 2% inflation and be on track to see inflation moving above 2%. They tend to move together. So that's not to say inflation might not move up, but for inflation to move up in a persistent way that really starts to move inflation expectations up, that would take some time, and you would think that it would be quite likely that we'd be in very strong labor markets for that to be happening. If that actually were to happen, though, there's a paragraph in the statement on longer run goals and monetary policy strategy, which says that when the two goals are somewhat in conflict, we weigh various factors, including the time it would take to get back and forth. So it doesn't really tell you what to do, but it tells you that we will weigh those two factors and how far we are away from them and how long it would take to reach them, or were we to reach that sort of pretty unlikely state. We're a long way from full employment. Payroll jobs are 8.4 million below where they were in February of 2020. We've got a long ways to go, and also, it's going to be a different economy. So we've been hearing a lot from companies that they've been looking at deploying better technology and perhaps fewer people, including in some of the service industries that have been employing a lot of people. It may well be, it seems quite likely that a number of the people who had those service sector jobs will struggle to find the same job and may need time to find work and get back to the working life they had. These were people who were working in February of 2020. They clearly want to work. So those people are going to need help. And so while I would say we haven't seen really highly elevated levels of unemployment for, up in the teens that we thought we might have for an extended period of time, we've still got a lot of people who are out of work. We want to get them back to work as quickly as possible, and that's really one of the things we're trying to achieve with our policy. So my guess would be that you will see people coming back into the labor force, and these jobs will be the labor market will reach equilibrium. Maybe pay will go up, but I do think that, and I do think also the unemployment insurance benefits will run out in September. So to the extent that's a factor, which is not clear, it will no longer be a factor fairly soon. So my guess is that we'll come back to this economy where we have, equilibrium between labor supply and labor demand. It may take some months, though. First thing to say is that we feel an obligation to understand the technology and all of the policy issues very, very well. Central bank digital currencies are now possible, and we're going to see some of them around the world. And we need to understand whether that's something that would be a good thing for the people that we serve. How would it work in our system? And there's some very, very difficult questions to answer, but I think we are engaged in a serious program to understand both the technology and the policy issues. I would say this: we're the world's reserve currency, and that means that the dollar is used in transactions all around the world far more than any other currency, and that's because of our rule of law, our democratic institutions, which are the best in the world, our economy, our industrious people, all the things that make the United States the United States. That's why we're the reserve currency. And of course, we have open capital accounts, which is essential if you're going to be the reserve currency. So those are the factors that make us the reserve currency. I'm less concerned that another country might have a digital currency first. Ask yourself the question: does that mean that if you were a company that's doing international business, would you then suddenly start to use that currency to do your international transactions, or would you still do them in dollars, which is what everyone does? And I'm not so concerned about that. I am really concerned about getting it right. It is a tricky set of questions that we have to navigate in a world where we already have, remember, a highly evolved payment system. We have FedNow and other immediately available funds. Pretty soon, everybody will be able to do what people do in other parts of the world, which is just use their phone to make immediately available payments all the time. It'll be normal. And what would be the role of a central bank digital currency in that kind of an environment? Far more important to get it right than it is to do it fast or feel that we need to rush to reach conclusions because other countries are moving ahead. I mean, the currency that's being used in China is not one that would work here. It's one that really allows the government to see every payment that's used for which it is used in real time. It's much more to do with things that are happening within their own financial system than it is, I think, to do with the global, sort of global competition. It's been well within target and target range, and money market conditions are fine. We have the ability to use our administrative tools to make sure that remains the case. We do expect further downward pressure on rates through asset purchases and also the runoff in the Treasury General account. But at this point, we didn't see a need to deploy our tools to support rates, and of course, we will do so if the need does arise.
What I'm saying is when do we need to lower the amount of treasuries you're buying, sort of taper off a little bit? When can it stand without having that support from the monetary policy side, and then for the transitory?
Okay, sorry. So we've articulated our test for that, as you know, and that is just we'll continue asset purchases at this pace until we see substantial further progress, and we're going to communicate well in advance of any decision. We're going to let the public know that that's what we're thinking, and so there'll be a lot of warning and that kind of thing. But it's about substantial further progress toward our goals. That's really all it is. It doesn't have any external virus related specific requirement. Although again, I do think the virus will need to continue to be controlled for us to achieve those economic goals. But it's really the economic goals. Now, your second question. Sorry, just say again. I didn't quite get that question.
Yeah, sure. With all the fiscal spending that's happened in the accommodation in it, does the system need more spending, either from the fiscal side or accommodation, or would more spending affect the transitory nature of the inflation and put those upward pressures on inflation long term?
So it's really up to Congress. We're not an advisor to Congress. We don't weigh in on specific fiscal bills or proposals. That's really between elected parties. Basically fiscal policy is the province of people who stand for democratic election and win, and they get to make those very difficult decisions, and they get to be accountable to the voters. We didn't do any of that, and we don't have a seat at that table. We don't seek a seat at that table. So that's really something for Congress and the administration to deal with.
Thank you. Greg Robb.
Rob from MarketWatch. Thank you so much for the for the opportunity. I want to circle back to the housing market. It's just kind of confusing the question and your answer. The housing market is strong, prices are up, and yet the Fed is buying $40 billion per month in mortgage-related assets. Why is that? And are those purchases playing a role at all in pushing up prices? Thank you.
Yeah, we started buying MBS because the mortgage-backed security market was really experiencing severe dysfunction, and we've sort of articulated what our exit path is from that. It's not meant to provide direct assistance to the housing market. That was never the intent. It was really just to keep that it's a very close relation to the Treasury market, and a very important market on its own. And so that's why we bought, as we did during the global financial crisis, we bought MBS too. Again, not an intention to send help to the housing market, which was really not a problem this time at all. So, it's a situation where we will taper asset purchases when the time comes to do that, and those purchases will come to zero over time, and that time is not yet.
Not whether you're thinking of tapering, but why you're not. We're seeing bank lending fall. The markets seem to be operating well. Are you afraid of a taper tantrum, or is it, as one money manager put it, if you get out of the markets, there aren't enough buyers for all of the Treasury debt, and so rates would have to go way up? Bottom line question is, what do we get for $120 billion a month that we couldn't get for less?
So it's really not more complicated than this. We articulated the substantial further progress test at our December meeting, and really for the next couple of months we're made relatively little progress toward our goals. And remember, substantial further progress from our December meeting. And then vaccination started to get more widespread. The economy reopened. We got a really nice job report for March. It doesn't constitute substantial further progress. It's not close to substantial further progress. We're hopeful that we will see along this path a way to that goal, and we believe we will. Just as a question of when. And so when the time comes for us to talking about it, we'll do that. And but that time is not now. We're not that far. We've had one great jobs report. It's not enough. We're going to act on actual data, not on a forecast. And we're just going to need to see more data. It's no more complicated than that.
Rates where they are doesn't change anything, but does it change anything if you actually tapered a bit? If you spent less, would you still get the same effect on the economy?
If we bought less, you're very faint. So if someone has volume, they turn it up. But if we bought less, no. I think the effect is proportional to the amount we buy. It's really part of overall accommodative financial conditions. We have tried to create accommodative financial conditions to support economic activity, and we did that, and we articulated the tests for withdrawing that accommodation. And we think, so we're waiting to see those tests to be fulfilled, both for asset purchases and for lift off of rates. And when the tests are fulfilled, we'll go ahead. As we've done this before. We did it in the last after the last crisis, and we'll do it as those tests are satisfied. We'll do it, and the only thing that will guide us is, are the tests met? That's what we focused on, is have the macroeconomic conditions that we've articulated, have they been realized? That will be the test for tapering asset purchases and for raising interest rates.